Okay, thanks. We'll start this morning's webinar. So for this morning, we'll share on the SREITs monthly, US weekly, China weekly musings, and the HSI technical outlook. The SREIT total return was up close to 15% year to date, and this has outstripped the developers' return as well as the STI returns of 9% and close to 5% respectively. On the yield spread, it actually improved month on month. It inched back up to about 272 basis points. This was due to the increase in the SREIT dividend yield and the lower 10-year SGS yield. However, this is still below the -1 SD range. And bear in mind that the Bloomberg consensus forecast still factors in for an increase in the 10-year SGS at the end of this year and next year. And on the 3-month saw, it inched back up above the 2% mark to end at 2.05% as at end May. So for last quarter, we already shared for the subsector, the 1Q subsector indicators, and for the subsector monthly indicators, we have the retail sales as well as the hospitality. For retail sales, on a seasonally adjusted basis, this declined 2% year on year in April and was dragged down largely by the sectors of furniture and household and computer and telecom equipment. The F&B index was up 3.82% year on year, seasonally adjusted as well in April, and this was contributed across all subsectors. On the hospitality side, the average RevPAR saw a decline of a slight decline of about 1.6% year on year in April, and this was on both occupancy and ARR. So this could give a preview of the 2Q results for the hospitality REITs for the month of April. And the luxury segment was the only segment across the 4 hotel segments which recorded growth in terms of RevPAR of about 3.4% year on year. Visitor arrivals was flat in April. So our call on the SREIT sector is unchanged, neutral, with we're still bullish on the subsectors of office and hospitality, and our calls on the respective REITs on the right. I'll move on to Edmund for the US weekly.
Hi, thank you, Tara. So in terms of the US macro, for last week, the existing home sales saw a decent rise in May, but that does not mean that the activity will now take off, even with the interest rate set for further falls. This is mainly due to a subdued home buying sentiments, a lack of supply, and gradual tightening in the mortgage lending standards by the banks. And it's likely that you will keep the sales, the existing home sales close to their current levels over the next year. But set against that, a slowing economy will also encourage. Recently, the FHA have recently reintroduced rules to prevent a dangerous rise in more risky loans. And as for retail sales, the stronger 0.5% month-over-month rise in underlying retail sales in May reinforces our view that it's likely that the officials will wait until the September FOMC meeting before cutting the interest rates. As for manufacturing and industrials, the 0.4% month-over-month rebound in the industrial production in May was largely due to the volatile utilities output. So given the weak global backdrop and the slowing ISM manufacturing, we expect the manufacturing sector to continue to struggle in the second half of this year. In terms of the FOMC meeting, the Fed has dropped their earlier stance to be patient. Jerome Powell also mentioned that the weaker global growth plus the trade policy uncertainty has raised the downside risks to the outlook, which means that it's very likely for the FOMC to cut interest rates in time to come. So although the data continues to weaken, but we don't really see a sharp fall, which means that it's very unlikely to see a rate cut next month. And it also depends on the outcome of the G20 meeting, which brings us to the trade war. So we do think that the dispute with China will ultimately escalate further, but next week's meeting may conclude with exchange of words and agreement to restart the talks. So this will probably send the stock market even higher. So with that, I'll pass on my time to Jie Yuan for the China review.
Thanks, Edmund. For China last week, there is a beginnings on the stock market. We are thinking it's basically because of the two reasons. For the first reasons, we are thinking because of the on last Tuesdays, US and China's president are having a phone calls. We are thinking that these two sides are back to the negotiations again. The second reason to is thinking is because of the US pressures to lower down the interest rate, leads the pressures for the RMB. We are seeing the financial stock are still gaining the quite good positive returns. On this week, the affected factors will be the G20 meetings. We are thinking the G20 meetings, that means the two China's and US side are back to the discussions again, but there is no sense they were making the deals in recently. We are positive on the financial. We'll continue to be positive on the financial stocks, especially for the investment bank and the brokerage. We are thinking because of the new boards, the Cochon board is established. Also, the stock connected between the China and the London has been settled. There will be a revenues gaining momentum for the brokerage companies. This is a list of the brokerage company, including in the CSI 300, and the number is their weekly performance. I will pass to Le Weiren for the technical pause. Thank you.
Okay, now we currently start for the Hang Seng Index technical outlook. So based on the earlier wave count, minor wave count, we have the minor wave count has been completed for the impulse wave from 8 February 2016 to 22nd January 2018, a period spanning close to 2 years. If you look at now, we are currently in the corrective phase of the intermediate wave of ABC is yet to be completed, and the sub-corrective wave of wave C is most likely to break the 30,000 psychological resistance level. Should it break this level, then the C wave of the intermediate wave will be at 32,000. And once it hit 32,000, there's a very great possibility that you'll fall to 24,000 region over here. However, there's another alternative scenario. If price reject 30,000 psychological level, and this will form a double top. And should it form a double top, and the new wave C target will be actually lower than the expected 23,000, you'll be at the 21,385 region. But however, for a short-term scenario, we are sentiment. We are looking at a bullish sentiment. Target price 30,000. So with that, I end my presentation. Thank you very much. Is there any question, by the way? There's a request to flash a sign on SREITs outlook. So I will flash it.
Hi, so yeah, continuing on the response to the question on the REITs, the Singapore REITs. Sorry, the question is not appearing now, but from my recollection, the question was whether or not the REITs are currently already pricing in the Fed rate cut, or will the prices react higher once there's any cuts in the rates. As I explained earlier, there's two ways you can look at it. From the yield perspective, which is the yield spread that we have always been talking about, which is the SREIT yield over the 10-year SGS, and also from the finance cost perspective, which essentially lies on the 3-month SOR. So on the 10-year SGS, this has traditionally not really followed very closely to the Fed fund rate. So on that side, we have to look more into factors of the who are the buyers and sellers of the long-term securities. And then on the 3-month SOR, while this has the pattern has kind of followed the Fed fund rate, we have to remember that this is not pegged on the Fed fund rate. So it's not like the formula does not constitute that of the Fed fund. But all things are unchanged. If there's any movements, the 3-month SOR would traditionally follow. But bearing in mind that there are other factors in the there are many handles within the economy that can be played on the macro level as well that could contribute to the movements in the 3 months. However, on the finance cost side, most of the REITs already hedge 70% of their finance costs on a fixed basis. So it would be quite costly for them to continuously change their hedging policy here and there. So they have a more longer term perspective for the capital management side of things.
There's a question on the Fed Fund futures reflecting a rate cut. So yes, according to the Fed Fund futures, it suggests that there's not only going to be a 25 bips cut in July, but also there's a chance of a 50 bips move, which is 30%. But that actually begs the question, because if the Fed has already decided to cut rates in July, they shouldn't, why would they wait? So according to Jerome Powell, there's not much support for an immediate rate cut. If you look at the data, most of the figures are showing slowdown in the economy, in the manufacturing, in retail sales. But I think there's not a very huge sharp decline yet. So I think they are likely to wait until maybe after the G20 meeting to decide on whether there's going to be a rate cut. And that said, regarding the trade war, we think that the dispute with China will, of course, not be resolved during the G20 meeting. It'll probably just be a small agreement to restart the talks. So it is more likely that rate cut will happen in the September FOMC meeting.
Okay, so now there's a question on the Lion Phillip SREIT ETF. So actually, can you specify your question? Thanks. So there has not been any response on the to specify the question on the Lion Phillip SREIT ETF, but I would assume that you would be asking about how this would trend, how the price of the ETF would trend. I think you can look at the weightings of this ETF. If I'm not wrong, there will be heavier weights on the Kaplan REITs as well as the Ascenders and the Mapletree REITs. So those REITs would kind of like move the ETF more so you can monitor those REITs more. And on the ETF on the whole, on a macro basis, you should take a look more on the macro basis, as that will affect all the REITs at one go. Okay, so there are no other questions. We'll end the webinar. Thanks.